Right, we are using this session to prepare for test number 1, good people. Right, remember we have another session which is coming in on Sunday from 2:30 p.m. up to 6:30 p.m. Now remember you have the following topics that you need to cover: conceptual framework, right? You have income taxes, right? You also have revenue, right? Plus leases. Right, so basically, these are the topics that are relevant for the test that we are doing. So today we are going to touch base on leases, and then the other topics we'll look at them on Sunday. Right. In terms of the topic of leases here, right, they've basically said that or they are providing material for the lessor, not for the other side, which is the lessee. Right? Because it is assumed that you have already done the lessee in the previous module in 2601. So it doesn't mean that the lessee is not examinable. Just check the TET one from last year. Most of the list there was on the lessee, yet they said the same thing that we're concentrating on the lessor. Right, so to be on the safe side, let's cover both the lessor and the lessee. Right, to make sure that if they surprise us and give us the lessee, then we have covered that at least in the meantime. Right, for Sunday, I think what we'll do, we'll cover the test that was covered in the previous year. It has got income tax there, it has got, I think at least it has got conceptual framework. So all the topics are represented today. Right, let's cover that on Sunday. But today, let's look at the topic of leases. Right. If we look at the topic of leases, good people, let's start by looking at the definition of a lease. Right. Those who attended my previous class, right, we had already started on the lease, but we only looked at one side, which is the lessor. So today we are going to cover the lessee as well as revise the lessor. Right. Basically, a lease is a contract. Right. It is a contract that gives the right of use. Right, it is a contract that gives the right of use, right, of an identifiable asset, right, of an identifiable asset for a period of time, right, for a period of time in exchange for a consideration, right, in exchange for a consideration, right. I want to give you already some homework to do, right. I want you to look at identifying, right, if a contract, right, contains a lease, right, in terms of IFRS number 15. This is it. This is IFRS number 16. Remember, IFRS 15 is revenue, right? In terms of IFRS number 16, right? So sometimes you get a theoretical question on this, right? Identifying if a contract contains a lease or not. You should be in a position to answer that, right? I know it's there on the study guide. If you can't find it on the study guide, on the textbook, it will be there and they will give you an example. Please go through that particular example just in case you get a question on theory on that. I want to concentrate on the much difficult stuff, which is the calculation. So this small theory, please cover it. If it does come, it will contain maybe 5 to 8 marks and chances are high it comes. We want you to be able to answer that as well. Right, so it is a contract that gives the right of use of an identifiable asset for a period of time in exchange for a consideration. For example, right, where you are staying, if you are renting, right, if you are renting an apartment, right, that's an example of a lease. Right. Remember, you then get to be given the right of use, right, of the apartment, right, but you don't get it for free, right? There is a consideration that you pay, right? And remember, the right of use is given for a period of time. It is not indefinite. So you sign a contract maybe for 1 year, for 2 years, right? So basically, that's an example of a lease, right? If you buy a car, right, on a contract basis, right, that's also an example of a lease. So these are some of the examples of leases that we have, right? So we want to look at a lease, and then we want to maybe specifically indicate that there are two parties here, right? There are two parties involved, right? We have one part that we call the lessor. We have one part that we call the lessee, right? So the lessor is the original owner of the asset, right? The lessor gives the right of use, right? The lessor receives the consideration. So this party is called the lessor. The party that receives right of use, right, and pays the consideration, right, that party is what we call the lessee, right? So it's very important when you get a question on a lease that you identify in whose books you are going to be answering in, right? Because the way that you account in the hands of the lessor will be different from the way that you account in the hands of the lessee. So don't just answer the question, identify who the two parties are, go to the required and see on whose hands you are going to be providing an answer so that you provide the correct calculations and you answer the question properly. Right, so for our first part, we are going to look at the lessee. So first we are going to look at the lessee. Right, so we want to find out how a lease is accounted for in the hands of the lessee. Right, so there are two methods, right, of accounting for a lease. Right, there are two methods of accounting for a lease, right, in the hands of the lessee. Right, the first method is what we call the exemption method. Right, so we have a method called the exemption method. Right, this is the easier and straightforward of the two. Right, but maybe I will explain it if time permits after the question that we are going to do. I may explain it, but if time doesn't permit, you remind me on Sunday. I'll just go through it quickly. Right, the exemption method is an alternative, right, method provided for. Right, it's an alternative method provided for in IFRS number 16, right, and only applicable to, right, what we call low value assets. Right, this is an asset, right, whose value when new, right, is US dollar 5,000. So the standard costs a figure of 5,000. So it's an asset which, when brand new, cost 5,000 rand. Right, but I've never seen a question where they ask you to determine whether it's a low value asset or not. Normally they tell you. So I would imagine if they wanted you to determine, they will give you an exchange rate. And then we've got a short-term lease. Right, so the term of the lease, right, is 1 year or below. So any lease that is 1 year and below, it is called a short-term lease. Now, this exemption method, right, is voluntary, meaning to say an entity may choose the other method if they so wish. So it's not enforced by the standard to say when you have got a low value asset or a short-term lease, you must always use the exemption method. It's a voluntary method. The entity can still choose the other method. Right, I will come back to this one. Right, I want to go to application, right, of IFRS number 16. So this is the default way of dealing with a lease, right? All those leases that don't qualify for short-term or low value asset are automatically going to be treated in terms of IFRS 16. Even low value and short-term leases, if the entity so wishes to, they can still apply IFRS number 16. Right, so we want to look at this method and say, how do we account for this? Right, accounting for a lease, right, in terms of IFRS number 16. Right, so we're going to say at the inception of the lease. Right, or what we normally call initial recognition, when we recognize the asset in the books for the first time. Right, what am I writing? Recognition. Right, so we want to look at the transaction that must take place. Right, number one, the lessee needs to recognize a non-current asset. Right, called the right of use asset. Right, so remember you are given the right to use the list assets. So therefore, you are going to recognize that in your books and you call it the right of use asset. If it's land, you say right of use and then you say land. If it's building, you say right of use and then you say building afterwards to identify maybe if you're having two different classes of assets that you're leasing. Right, so this is called the right of use asset. You have to recognize that when you enter into the lease. Now remember, an asset by nature is not recorded or recognized as an asset because you own it. An asset is usually recognized because you have got control over it and you determine how it is going to be used. And the asset has got the potential to generate economic benefits for the entity. So we are saying, if I own a motor vehicle, it means I've got rights to the motor vehicle, right, in terms of the conceptual framework. And these rights have got the potential, right, to generate economic benefits. Right, so if I've got a vehicle that I'm using in my business, right, the vehicle together with the other assets that I have is what I base my ability to generate economic benefits on, right? And I will have control over the asset. So I have the right of ownership of that vehicle through the fact that I purchased it. It's mine. So that's what gives me the right over the asset. The asset can be used together with other resources to generate economic benefits, and I have control. Control means you determine use. Right. So you have the right to determine the use of the asset, and you also benefit, right, from substantially all economic benefits derived from the asset. Right, all economic benefits right, of the asset. Right, so this asset, I have all these rights because I've purchased it. Right, if I am leasing an asset, right, the contract of lease gives me the right of use over the asset, which gives me also the ability to generate economic benefits by using the asset. It doesn't matter whether the vehicle is mine or not. If I'm using it in my business, I can be able to generate economic benefits. Right? And then control, as long as I determine the use, when I've been given a vehicle and I'm the one who decides where it is going to wake up and go in the morning, right? Which direction is going to go today, and basically determine how it is going to be used. It means I have control, right? And if I have the ability to benefit from the economic benefits substantially. So it doesn't matter whether you own a vehicle because you purchased it or you have a vehicle in your control because you are actually leasing it out. As long as it satisfies one, two, three, then you should recognize the asset in your books. So that is why we are saying that you must recognize the asset which you call a right of use in your books. Are we clear, good people? Right, are we clear?
Yes, David.
Right.
David.
Accounting is very easy and very logical at sometimes. You need to think about it like that. Right. If I've got a motor vehicle, right, which I am acquiring on credit, right, maybe the vehicle is 100,000, right? It simply means that I'm going to recognize my assets, which is the motor vehicle that I'm recording in my books. But at the same time, because I have not paid for it, normally you will then credit trade payable. It's a credit. Now, this one is an asset. This one is a liability. Right, so you have a liability because you have the use of an asset, you have the right of an asset, which you have not paid for. So therefore, you are being financed by the other entity, right, to get the vehicle on credit. So we normally have this. Right. However, we need to be very clear about a situation like this. Normally, when you are recording trade payables in your books, right, it means that there is no significant financing. Right, there is no significant financing in the transaction, meaning to say that you are still within the payment terms of the supplier. So usually these are short-term payment terms, like say you are paying in 1 month, you are paying in 2 months. Normally they don't attract interest. When we say there is no significant financing, we are saying you are not being charged interest. When there is significant financing, you are going to be charged interest. From an application point of view, right, any sale with payment, right, within a year, right, normally does not attract financing. So that is what the standard says of revenue. If you go to the IFRS number 15 where it talks about revenue, it will tell you that. So if the transaction is such that the sale is payable or the whole amount that is for a particular purchase is payable within 12 months, then there is no significant what? Financing. Right, so this will be a simple transaction of purchase, only that there is a small delay in payment without you being charged interest. However, most of the time when you deal with leases, there is a small problem in that usually leases can be for a full year, 2 year, 3 year period, which means most of the time leases do attract significant financing. Right, so how this is going to play out, if you want to buy a motor vehicle today, you go to the garage, you are likely to see a cash price being displayed for that particular vehicle. Let's say it's a cheap one, 450,000. Right, but if you want to buy the vehicle over a longer period, which means you want financing, right, you end up paying interest. You will be charged interest. Usually these things are over the duration of a period of 6 years. Right, you may end up having to pay an additional 8,000. So these are fictitious figures, by the way. which means you may end up paying a total of 230,000, which will be the total payment amount. Right, so a contract of lease, most of the time, where there's IFRS number 16, right, usually we're dealing with assets that are going to be leased over a period longer than what? 1 year, which means they attract what? Significant financing, which means they attract interest. Right, so you then have a situation like this, but a situation like this you must be very clear about. If you go to this vehicle, right, if you go to this situation, if the vehicle is 150,000, then you are owing 150,000. That is what you are being borrowed. Only that there is no interest. It's a short-term borrowing which does not attract interest. But we are very clear the cost of the vehicle is 150. So therefore, theoretically, you are being borrowed 150 by the person who is supplying you. He is financing you on a short-term basis. But when we go to this one, there is a long-term finance. You will have to reward the person that is giving you the car over a long period of time, right? By paying interest. There are two ways of doing this. You go to the garage brings in a financial institution. The financial institution borrows you the money and charges you interest, and the garage get their money, which is 150. That's it. Or you go to a garage which has got its own financing, they give you the vehicle and provide you with financing, and the interest goes to them. But at the end of the day, you will pay interest and end up paying more than the original cash price. But we must be very clear, right? Even though there's going to be interest, this here is future interest. On the day that you go into the transaction, you are not yet owing this. When someone borrows you 150, at the point of borrowing you the money, you are not owing them the interest. The interest is going to be paid over time. So therefore, we are saying this amount here is equivalent to the liability that you incur. So that therefore, on the day that you actually receive the asset, you must recognize what we call the lease liability. Right, you must recognize the lease liability, right, which in simple circumstances would be equivalent to the cash price. So those are the two main things that you recognize on the day that you enter into the lease. Any question, good people? Are we understanding this? Right, are we there?
Yes.
Right, so remember, from an accounting perspective, if you're applying IFRS number 16, the asset is going to be recognized in the hands of the lessee. Right, so what it means also on the other side, in the hands of the lessor, they must de-recognize the asset there. An asset cannot be recognized by two entities from an accounting perspective. It has to be recognized by one entity. So therefore, the lessor is going to de-recognize the asset from its books, and the asset is going to be recognized in the hands of the lessee. Right, let's continue. Let's say subsequent. Right, so subsequently, how do we treat the lease? Right, we must be very clear. Right, the right of use asset must be depreciated. Right, the right of use asset is carried at its carrying amount. Right, which is going to be the original cost recognized there minus any accumulated depreciation. So we have to depreciate the asset, right, which means we have to recognize the expense of depreciation. Now, what happens with the lease? Right, remember you go into the lease at the inception date. Right, and then you are given the car worth 150,000, which is equivalent to the amount of money that you are borrowing. Right, then through financial engineering from someone who has done accounting at UNISA, right, using what is called the interest rate implicit in the lease, right, the financial person will engineer and determine what the interest is going to be over the duration of the lease, right, and you end up now with the what? with the 250,000. Right, the financial engineer should then come and say 250,000, which is the expected total amount over the duration of the lease, right, divided by the number of years of lease. So if the lease is for a period of 3 years, so then we can divide it 230,000 by 3, and it's going to give us how much? So that is going to give us 76,666.67. Now, this amount is what we call the installment amount. So this is what the lessee will have to pay at the end of each of those 3 years. So therefore, there is going to be payment, right, of installment amount. Now remember, the payment of installment is covering two different type of things. Number one, there is the lease liability. You are clearing a portion of the amount that you borrowed. Number two, you are paying what? Finance cost. So therefore, the installment needs to be split in half, or not in half, into two, right? The lease liability part payment, right, and the interest payment. So to do that, we use what we call the amortization table. Right, we use the amortization table to split the interest between that. So that therefore it means that we are going to reduce the lease liability with part of the payment, and we are going to recognize, right, the finance costs. Right, so this is what we need to do with our lease. Right, let's also explain on depreciation. Right, on depreciation, you need to check if the lessee will retain ownership. Right, of asset after the lease. Right, so if that is the case, you use the useful life of asset, right, for depreciation. Right, if they are not going to retain the use of assets, right, you use the shorter of useful life, right, and the lease term. So you need to be careful about the calculation of depreciation. So if the asset is going to go back to the lessor, you use the shorter of the useful life and the lease term to determine the amount of depreciation. Right, for leases, you should be able to do journal entries. You should be able to also do what we call disclosure of the notes in the financial statements. That's what they normally ask, right? Disclosure, journal entries, and also I did mention a discussion. You need to be able to discuss a little bit, especially on the homework that I gave you. Right, any questions, good people, on the theory? Are we on the same page? Right.
Yes, we are, David.
Let's go to the calculations. Right, so when you deal with a lease, right, normally the first thing that you calculate is what is called the interest rate implicit in the lease. Right, you need to calculate the interest rate implicit in the lease. I think there's a Y there, implicit in. Now remember, an entity will have its general interest rate for financing purposes. All right, so yeah, please mute somebody. Thank you. Right, please mute if you're having noise. What we do is we do allow you, even if you have got manageable noise in the background, to unmute, make a comment, make a contribution, and then unmute after. Only unmute if you are making a contribution so that the class is smooth. Thank you. Right, I am going to ask.
Hello, we are talking about you. Hello, please.
Yes. I blocked the wrong person. Hey, sorry about that. Unmute. All right. Right. Okay. Right. So we've got the interest rate implicit in the lease. So we are saying that an entity will have a general borrowing rate, which is the rate that the entity is charged in the market in general, taking into account its perceived risk. However, a lease contract is an agreement between two entities. Of course, they will look at the risk, but they will agree on a certain percentage that works for the two of them, which may be different from our general perceived interest rate in the market. Right, so you always need to find out the correct amount of interest. This is because usually questions don't give you this amount that I was giving here, the interest amount. They don't give you that. Right, normally they can give you the installment amount, and then they give you the original cost of the asset, which we call fair value. So, but for you to be able to do the amortization table, you need to know the interest that they use. So that is what we call the interest rate implicit in the lease. So to calculate that, you need the PMT, you need N, you need future value, you need present value, and then you compute your I. So obviously we need a financial calculator here. Right, the PMT is always the installment amount. Right, N is the number of times. Right, N is the number of times. Right, PMT will be paid. Right, for the duration of the lease. Right, the future value is what we call the guaranteed, right, and unguaranteed residual value. Right, then the present value is the fair value of the asset, which is usually equivalent to the cost price, plus what we call, right, the initial direct cost of the lessor. Right, so installment is straightforward. Normally it's given. If it's not given, it means they will give you the I, which is the interest rate implicit in the list. Then you will have to determine the installment amount. You will have to work backwards, making PMT the subject of the formula. Right, the number of payments, also you can calculate that number of PMT payments. You'll be able to calculate that. You need to determine how many times in a year you are paying multiplied by the number of years of the lease. If you are paying once in a year and the period of lease is 3 years, it means you are making 3 payments. If you are paying twice per year, it is 2 multiplied by 3, which gives you 6 payments and so forth. Right, then we have the guaranteed and the unguaranteed residual value. Right, so normally when it comes to the residual value, right, it's similar to what we normally have in accounting, normally when we deal with PPE. Right, what we are saying is that a lease may be for a period of, say, 3 years. But it doesn't necessarily mean that after the 3-year period, the asset has got a zero value. Sometimes it may have a residual value at the end of the lease. So this is the expected value of the asset. Right, this is the expected value, not fair value, just value of the asset, right, after end of the lease term. Right, after the end of the lease term. So if you give someone an asset which is worth 150,000, maybe after 3 years you expect the asset to have deteriorated by 100,000, which is wear and tear, but to still have a value of 50,000. So this will be the residual value of the asset. Now, what happens, the lessee will want to recover that value from the lease contract. So if I give someone a Mercedes-Benz, I'm leasing it out to a company that gives it to their managing director to use for 3 years. And after 3 years, my Mercedes still has got a value of 50,000, right? I can then say, if you want to return back the asset to me, ensure that its value is 50,000. Or I can say, if you want to keep the asset, then you've got to pay me 50,000. Then you can keep the asset. Now we then have, when it comes to residual value, we have what we call guaranteed and unguaranteed. Right, so we've got the guaranteed and unguaranteed. Now remember, we are saying the lessor wants to be assured that they will get a value of 50,000 at the end of the lease, which they can get by receiving their car back with 50,000, or they can have cash being paid to them, either by the lessee or by a third party who is unrelated to the lessor. Right, for example, a garage may be involved in the transaction. Maybe there is a garage that we know that normally takes second-hand cars. When we are organizing our lease, we involve them. To say that we are leasing our asset, which is worth 150, after 3 years, it should be worth 50,000. However, we will not require it as the lessor after the 3-year period. We want to sell it to the garage. So if the garage comes on board and says they'll buy the asset for 50,000, right, it means that they have guaranteed the 50,000, even though they are not part and parcel of what? Of any of the two companies. So it can be a guarantee by either the lessee himself saying, I'll buy the asset for 50,000, or by any other third party who may come on board and say, okay, we are willing to take the asset after the 3-year period for 50,000. Right. So the guaranteed residual value is the promised, right, payment by lessee or third party, right, for the residual value. Now, it can happen that the guaranteed residual value is 50,000, right? If the guaranteed residual value is 50K, then the unguaranteed residual value is 0. It means the whole amount has been guaranteed, right? However, sometimes there may be negotiations that take place, and the lessee or the third party that takes the asset may negotiate the fee down. So, which means we know that the expected amount is 50,000, but this guy can then negotiate 40,000. Right, so we are saying out of the residual value of 50,000, only 40,000 has been guaranteed, and then it means that there is an unguaranteed residual value, which is 10,000. Right, in either way, it doesn't matter to the lessor, he will still recover his 50,000 one way or the other. And we are saying that if you negotiate at least a reduction of the guaranteed residual value to 40, he will get you via the interest amount. So the interest amount will always be designed in such a way that the lessor will be able to recover his full 50,000. So how do we do that? By making sure that as part of the lessee future value, we include both the guaranteed amount and the unguaranteed amount, and it will have an impact on the I. Right. Are we on the same page with people?
Yes, sir.
Yes, David.
Right. I want us to be reminded here that we are dealing with cash flows. When you use your calculator now to calculate the I, or to calculate the PMT, or to calculate the future value, right, you should always remember that that type of calculation only uses cash flows. So no non-cash flows are going to be included in this calculation. Right, so it has an impact in terms of the residual value guarantee and unguaranteed. Right, so this is what it means. Right, cash flows on residual value. Right. At this level, what I'm explaining to you, you must be very clear about. In the other modules, maybe second level is not very important because they don't go that deep. But here they can surprise you with this. So please pay attention. Right. So what happens? Let's say the guaranteed residual value is 50,000. There is no unguaranteed residual value. All right, I want to talk about the guaranteed residual value anyway in this particular instance. Right, let's say the guaranteed residual value is 50,000 in full, right? And then let's say that the lessee wants to keep the asset. Right, it means they must pay 50,000. So therefore, the whole 50,000 will be included in the calculation. It's a cash flow. So that one, there are no two ways about it. Now, let's say the asset is returned. Right, to the lessor. Right, let's say the asset is going to be returned to the lessor. Right, assuming the full guarantee has been what? Or the full residual value has been guaranteed. Right, it simply means that we are expected to derive or to give a value of 50,000 to the lessor. Right, so if the question, right, if the question is silent, right, on the projected fair value, right, on conclusion of the lease. Right, assume a cash flow of 50,000. So what it means is when you're calculating here, when you're saying guaranteed residual value, the unguaranteed, don't worry about it. You always put it if it is there. Always put the unguaranteed amount if it is there. So it means here on the guaranteed, you put 50,000.
Sir,
You can go ahead.
you're saying if, for example, they're saying our amount is 50, but there's an unguarantee of 10,000, we should always add it.
I am saying, for this example that I'm explaining, assume that the amount of the guarantee is actually 50,000, all of it. It doesn't matter even if you say 40,000. Ne?
Okay.
Right. So as
So I
long,
wanted to understand if, because I was doing this other question, it has like a split amount
all right.
of
So
a
all right.
average.
So here I'm explaining. Let me explain the guaranteed residual value. Let's be clear about that. Ne?
Okay. Okay.
Guaranteed residual value. Right. So in this instance, if we are using that, then we use 40,000 today for the unguaranteed residual value. Ne? So which means here you use 40,000. This one you always put. It's what you call
Oh,
an opportunity cost. It must always be there. 10,000. So here, if we are saying the guaranteed residual value is 40,000, right? And then they say that the asset will go back to the what? To the lessor. But they don't give you a projected expected fair value of the asset. You just use
okay.
the whole amount in your calculation of I as your guaranteed residual value. But
Oh,
sometimes if the question, right, gives you, right, expected, right, so if in the question they provide you the expected fair value of the asset, right, at a conclusion of the lease. Right, let's give you some examples. Right, if fair value is, say, 45,000 rand, right, All right, let me say if the fair value is equal to or above the 40,000. Now remember, as the lessee, you are expected to deliver to the lessor an asset at least which guarantees him a value of 40,000. So if you give him back an asset with a value of 40,000, and the question is giving you that expected 40,000 at the inception of the lease, then it means you are going to satisfy the guarantee by giving the lessor a car, and therefore you don't need to pay cash. Right, guarantee is satisfied, right, by giving the car back, right, and hence no cash flow. So which means therefore here it's going to be 0. You don't have to pay any cash amount. You have given them back a car that is worth the amount that you guaranteed. So you satisfy the guarantee by giving back the car, not by paying cash. Are we clear?
Yes.
Right. Are we clear about that?
Yes.
Right. Let's look at example number 2. Right. Let's say they say fair value, right, is equal to 30,000. So you are giving them a car which is worth 30,000. But your guarantee was how much? 40,000. Right. So it means that you are short by how much? 10,000. Right. So therefore, okay, sorry. Let me say minus 30,000, which you have. Right. Let's remove that. So which means ultimately you owe an additional 10,000 to meet the conditions of the guarantee. Are we clear? So therefore, you are going to give them the car. There is no cash flow there because the car is going to be worth what? 30,000. But you have to add a cash amount of 10,000. So therefore, the residual value guarantee is going to be 10,000 here. We deal with cash flow, not an asset that is sent back. Are we clear? Right? Are we on the same page? Yeah, right.
Yes, David.
Yes, ma'am. Right. So if you then, if you scrap the car, you have been very careless with the car and the fair value is expected to be 0. It means you must pay them 40,000 in cash to satisfy the guarantee. Then in that instance here, you put 40,000. So sometimes they do give you those complicated situations. You need to be on top of that. Any question? Right, you go through that again and make sure that you understand it. Right, after calculating the interest rate implicit in the lease, you need to calculate what we call the right of use, not the right of use, the lease liability amount. Right, you need to calculate the lease liability amount. Right, to calculate the lease liability amount, right, you discount, right, future cash flows or future cash payments, right, you can say flows, right, by lessee to lessor, right, using the interest rate implicit in the lease. Right, so to calculate that, you need your PMT, you need your future value, you need your N, you need your I. This time you compute present value. So this one, the PMT, it is always your installment amount. Right, the future value, you only use the guaranteed residual value amount. Right, exclude the unguaranteed residual value amount. Right, remember, this takes into account the payments by lessee. The unguaranteed residual value will be paid by a third party unrelated to the lessee. It won't be paid by the lessee because the lessee would have negotiated the fee down. So you only deal with the guaranteed residual value. Right, N is the number of payments. Right, this one is the interest rate implicit in the lease, calculated in the previous calculation here in 1. So whatever you would come up with as a percentage here, that is what you use there. Right, once you have that, then you are able now to calculate the right of use asset. Then you'll be able to calculate the right of use asset. Again, it's a very simple thing, simple accounting. If you buy something on credit for 150,000, you will need to recognize the asset for 150 and recognize trade payables for 150. So the trade liability amount is equivalent to the cost of purchase of the asset. So that is what we use. So we say here, what is the lease liability? So you say initial lease liability. Right, so you take that value into account. But we know that when you record an asset, sometimes there may be other expenses that are added, and we normally have the initial direct costs. Right, of the lessee. We add that. Let me leave it there. Sometimes there can be more things, but you will meet those in CTA. Right, then you can have the total. Now, initial direct costs are those particular costs connected with the lease that the entity would not have incurred had it not been for the lease. Right, had it not been for the lease, this is what they would have incurred. Right, please, 1 minute. I want to answer someone who is inquiring about this class here. So that right, so we have the right of use assets. This is how you calculate it. Right, from there, you can continue and calculate your depreciation because you have the value of the asset. And then from there, you can now compile your amortization table. Right, so basically, in short, in theory, this is how we are supposed to deal with this in terms of IFRS number 16 in the hands of the lessee. Any question before we attempt something?
Sir? Sir?
Yes, ma'am, please go ahead.
Can you please explain the 10,000? I think I had a network problems there.
The 10,000.
Yes,
Right.
the one that the guarantee, when you explain the guaranteed, I had everything, but the 10,000 is the
Right.
unguaranteed.
Yeah, the 10,000 is an unguaranteed amount, right? Remember, we are saying that the lessor normally, through experience, if they are continuously leasing out a certain type of asset, they will know that if they give you the asset for a certain period of time, right, they expect you to return back the asset with this value. So this is called the residual value. So now we are saying at the end of the lease, the asset is expected to have a value of 50,000. And this information, you get it from the lessor who has been leasing out this asset for some time. And they basically have an idea how much it will be worth at the end of the lease. Ne? Right. Normally, they will then expect to be guaranteed a value of 50,000 by the lessee to say that if you are going to return the asset back to me, let's write it into the contract that it's going to be in a condition that is worth 50,000 or more. Or if you want to keep the asset, let's write it into the contract that you are going to keep the asset and pay me 50,000 instead. That's a residual value. But remember, it's a negotiation. The lessee can still say, but your expectations, I think they are too high. Can we agree for a fee of what? 40,000. At the end of the lease, I'm willing to pay you 50,000 or 40,000, sorry, to keep the asset or to give you back your asset with a guarantee that it will be worth 40,000. If it does not reach 40,000 in value, I'll pay cash up to what? To bring the figure to 40,000. So this here is the guaranteed residual value. Of course, the expected residual value is 50,000 in the hands of the what? Lessor. But the lessee has managed what? To negotiate a reduction to 40,000. So the extra 10,000 that has not been guaranteed, that's your unguaranteed residual value. Right, so that represents an unguaranteed residual value amount. Are you perhaps answered today?
Yes, thank you.
All right, wonderful. Right, I'm going to stop the recording and restart it again.